Hello, everyone. This is Cathie Wood of ARK Invest, and this is the monthly call on Employment Friday. So, as usual, we'll talk about fiscal and monetary policy, and then I'm going to speak about market signals, the economy, and innovation, kind of all rolled up in one. So, a little bit different this time. Mainly because we're going to focus importantly on the question of inflation, what the indicators are showing us, and what the markets are signaling. So it's pretty interesting, I think. Anyway, so fiscal policy. I think the elections this week were a bit of a wake-up call to Congress to get something done. And yet, I'm not sure they're going to get everything they want done. So, what do I mean by that? It looks like the infrastructure bill will go through. As soon as the House passes it, it will go straight to President Biden's desk, and he will, of course, sign it. So, no problem there. The problem is Speaker Pelosi is adamant that that both bills, the infrastructure bill and the economic/social infrastructure bill, pass at the same time. And the reason for that is the progressives are adamant about it, and she needs to get the job done. I don't think that the economic and social infrastructure bill will go through. Maybe not until the midterm elections next November, not until those pass, because this election on Tuesday showed that policymakers are going to have to stay away from controversy. And there are a lot of tax proposals in the economic and social infrastructure bill that many voters in the swing states do not like. Polls are showing they do not like them, and I think the election this week placed. My sense is it is now placing, from a politician's point of view, more weight on those polls. So the moderate Democrats want a full Congressional Budget Office scoring of the bill to understand how much it really is going to cost. That is not going to happen for a few weeks. And it will take that long for the CBO to score it. So that means the infrastructure bill won't get a vote either if Speaker Pelosi still hews to the progressives' point of view. And then on top of that, even if the House were to pass this bill, it would then go to the Senate. And I'm talking about the economic and social infrastructure deal. And in the Senate, we have Joe Manchin, who it seems to me is saying that he's not going to vote for anything like this bill, even though it's been slimmed down a bit. He keeps talking about fears of too much debt, too much inflation. And recently, he's been talking about taxes. And he just thinks that the taxes in this bill are too onerous. And it would, his words were, revamp the tax code in a big way. So I found that very interesting. He is now throwing taxes into the reasons he's resisting the bill, and I think he's feeling that he can get away with this and hold up the whole shebang. So I don't think it's going to go through. I could be proven wrong. If it does go through, it will be much smaller than even the slimmed down version that the House has sent over, or will send over. So actually, that's really good news. Even if it does go through, however, I think that that there will be no capital gains tax rate increases and no corporate tax rate increase. Um, there will be a minimum corporate tax, which the world is agreeing on, the 15%. But compared to what we thought was going to happen, a near doubling of the capital gains tax rate and corporate taxes going up, the tax rates going up, it's much better. And I think that is one reason the market's been rallying. The probability of tax increases has been going down, except at the highest levels of income. And so there will be surtaxes there if this passes. So that's fiscal policy. I think it's playing out nicely. We've been thinking for quite some time that the onerous parts of the package would not go through. I think that's proven correct. Now the question is whether or not it will go through at all. And I would say no matter what the number is, $1 trillion, $2 trillion, as my professor Arthur Laffer says, you can just think of government spending as taxation. Now, the form of the taxation can be different. Sometimes it's outright tax increases. Sometimes it's inflation. Inflation is a tax, and paying down debt with inflated dollars is much easier. But that is a very regressive tax. On monetary policy, so very interesting. President Biden had both Jerome Powell and Lyle Brainerd in his office this week. And it seems like he's making a decision. Shall I keep Jerome Powell as Fed chairman, or shall I nominate Lyle or somebody else? And it seems that Powell has a lot of approval in Congress generally, but not with the progressives, because probably because Trump elected him. Treasury Secretary Yellen is in his camp, so we shall see. I think one of the controversies out there is his contention that the inflation we're seeing right now is transitory, and he's sticking to that line. Others on the Fed board are becoming a little bit more concerned. The money growth rate is still around 12.8%. That's where it has been since the beginning of the third quarter. So it has stabilized there, interestingly, down from 27% during the depths of the coronavirus crisis. So nothing changing there so much. But the question about transitory or not, let's think a little bit more about that. The market is going up. If the market were going up, I would imagine that fears of inflation were diminishing, but they do not seem to be. The headlines and actually some of the statistics that we've seen coming out are quite surprising on the high side. They're certainly surprising me. So let's talk about why inflation might not be transitory. And I'll cut to the quick and tell you, we do believe that inflation is going to come down dramatically. So we have not changed our point of view, but let's be fair and balanced about this and make sure that we do understand what's going on out there. It was very surprising this week or last week to see the union workers at Deere reject their proposal, reject Deere's proposal for wage increases, which in year one, I think, if I read this correctly, year one, 23%, and thereafter 5% for the duration of this contract. And they rejected it. So that is really interesting. That we haven't seen that kind of wage increase, and I'm talking about the 5%, in a very long time. So we've also seen other entities go on strike. Kellogg, the cereal company, on strike. So very different from, the heavy metal Deere union workers. Hollywood Crews are on strike against the studios. So, the strikes are not a good sign, and the wage increases, if they do go through, are either going to hit margins or are going to move through in the form of price increases, unless productivity offsets them. So productivity is output per man hour, and productivity increases are an offset to wage gains. So if wage gains are 5% and productivity is 3%, then we're in a 2% underlying inflation world. If productivity is 4%, then we're in a 1% inflation world. Productivity, we believe, is about to explode. But if it does not, these sorts of wage gains would turn into either inflation problems or margin hits, profit problems. So we're watching this very carefully. We did get a productivity number this week. We're getting all kinds of distortions right now because of the supply chain challenges out there and the after effects of the COVID crisis. So we're not. We've seen both productivity explosions, 11% one quarter, and implosions, down 8% another quarter. So those numbers are not to be trusted, and we've got to try and get at what underlying productivity is, and so we're watching carefully for that. Another price out there that has surprised us is the oil price. I'm on record as saying a few things about oil, but I have said that I would be surprised if oil prices surpassed their 2018 high. That was $77 per barrel. Today we're at $81 per barrel, and we have gotten as high, I think, as $84 per barrel. So I've been wrong on that, and in assessing why we're wrong, it's becoming very clear it's not the demand side of the equation. It is the supply side. We have ESG, so environmental, social, and governance objectives that pension funds are striving to achieve. And as a result, many pension funds, endowments, foundations are telling oil companies, look, we're not going to be buying your stock anymore. Because you're not shifting your capital spending from fossil fuels to renewables. And so a lot of companies are shifting their capital spending away from fossil fuels to renewables. And therefore, supplies are not growing as quickly as they were before. Here in the United States, fracking companies had a near-death experience last year. And because of the coronavirus, and they were highly leveraged, and banks had been the primary lender, and so banks have been very reluctant to lend to the fracking companies. Now we are seeing the capital markets starting to fund the fracking companies again, banks much less so. And then, of course, the third reason is OPEC. OPEC is being very stingy with its supplies. I think this week it came out and it said, in response to President Biden's request for increased OPEC supply, they basically said, this is your problem, not our problem. And I was surprised by that, because we know that Saudi Arabia in particular, and I do believe that comment came out of Saudi Arabia. It was effectively get lost. I was surprised. Anyway, we know they don't want demand destruction because they have huge reserves still. So they want to have demand continue at a decent rate, and they don't want the substitution into renewables to take place. So I was surprised by that comment. There might be something else going on behind the scenes, probably political, that we don't understand. Anyway, those are the three reasons supply has not increased as much as we would have expected. Now, demand is still below its peaks, and we shall see how quickly the substitution effect takes place, and will we ever go back to those peaks? I've been thinking no, but I've been surprised at how quick the rebound was, and we shall see. So oil prices do hit the headlines, they hit the pocketbook, they're plastered, or we're reminded of where these prices are as we pass gas stations during our travels. And so it's getting into the inflation psychology. We're seeing consumer inflation expectations tick up here for that reason. And this week, wheat, so talk about oil and food, wheat hit an all-time high. Now, that one we're seeing in the supermarket along with other food prices. Supply chain problems are part of the reason, but perhaps not all of the reason. Okay, so those are some of the reasons inflation may not be transitory. It's getting into the wage structure. If productivity does not pick up enough, could become a problem. And oil and wheat, food and energy, two necessities are up there, and could be a reason that striking workers are not settling here. So we're on watch for inflation. But let me give you one of the biggest reasons we don't think inflation is going to be sustained anywhere near these levels, and why some inflation indicators could turn out to be incredibly low, if not negative, deflation. China is one of the biggest reasons. We're looking at China today, much like we were looking at Japan in 1989. So in 1989, Japan was at the peak of its real estate boom. The Nikkei had hit 40,000 or was close to it. And the world largely thought, wow, there's no stopping Japan. And Japan's going to become the largest economy in the world. And of course, that didn't happen. Japan's boom, real estate boom, was destined to unravel. I'm sure many of you have heard this story where the emperor's palace in Tokyo, that piece of land, was worth more than the real estate in the entire state of California. Which also had seen nice real estate inflation. So that was destined to fail. And the Nikkei has yet to get back to that 40,000 level. So that's 30 years later, 2 years later. So China, what's the analogy here? Well, China's real estate has been very, very important in terms of propelling its economy forward. It was part of the infrastructure build out. They needed it. But it also became the most important part of consumer savings. By some estimates, 75% of all consumer savings in China is in real estate. Now, China's cracking down on real estate, and home prices are falling. And there's a bit of social unrest about it. But China's trying to tackle the have and have not problem. the social unrest. Why do certain people have these magnificent homes or are in magnificent buildings, and others can hardly afford a tent? And this has become unacceptable and untenable in China, according to its leaders. And so it's driving these prices down. And those who have the savings in the first place are losing the money. But this is a risk China's willing to take. I think China's playing with fire on this particular topic, especially because they are also targeting the financial regulators who oversaw financial institutions who were lending to the real estate sector. And the national government is also investigating certain financial firms. So, this is the lifeblood of their economy. And we're seeing signs of fraying at the edges. One price that I watch a lot trying to figure out what's going on in China is iron ore. The iron ore price since May, June has dropped more than 50%. And it tried to rally in the last month or so, and that failed. It has relapsed. And so we'll see if it breaks down to new lows. But that is very telling. We're seeing copper prices down 10 to 15%. Now, still very high by historical standards, but down 10 to 15% nonetheless. We're seeing digital commodities like the DRAM price coming down. They peaked, I think, in August. And DRAM prices are now down 25 to 30%. Now, that is a commodity that obviously is not just relevant to China, it's relevant to the world, as is copper. But still down 25 to 30%, that's something. And while some food prices and commodities are hitting all-time highs, we've got soybeans down 20%. Now, I remember this was from the late 70s, there was the expression beans in the teens, soybeans in the teens. And we did get up to, I think it was almost $15 per bushel. Now we're down to $12. Still high by historical standards, but nonetheless, a trend change there. So I've given you some market signals here. The China argument is very relevant, I think, or the most relevant. When China has caught a cold historically in the last since it entered the WTO, so in the last 21 years, when China has caught a cold, commodity prices get pneumonia. So we might be seeing the beginning of that with some of the commodity prices I just suggested. And I remember in 1989, we were also worried about inflation during that time as well. And I was thinking, well, goodness, if Japan keeps going like this and, taxing the commodity system, we could have a really bad inflation problem. And as it turns out, we were about to experience a bit of a bust. And I wouldn't be surprised if the same thing happened here because of China. What surprises me is that the headlines are not blaring this topic, China versus commodities, and it's because I think we're not paying attention to it because there are so many other dramatic things going on out there. On the side of inflation, and that has captured much more headline space than what's going on in China. But at some point in the future, I wouldn't be surprised to say investors, of course, how could we not have expected these commodities to unwind given what's going on in China? Now, the other reason I think we could see declining commodity prices and other prices down to finished goods is we've talked about the inventory buildup that has taken place during the past year and a half in our homes, including autos. During the last year and a half, most of us didn't want to take mass transit, and many of us bought a car that we may not have needed, an extra car, may not have needed if we were going to go back to mass transit. And so there may be inventory in the driveway or in the garage as well, excess inventory. I think because the dealer lots are so empty, there is a misleading impression that these auto manufacturers have got to build up these inventories again and give the dealers something to sell. Well, I think the consumer is speaking loudly here when it comes to autos, at least. The next car is going to be an electric vehicle. We're seeing that from the massive share that electric vehicles have gained during the coronavirus. And so maybe if they fill the lots up with gas-powered cars, which is 95% of their production right now, if they fill the lots with gas-powered cars, maybe they're not going to sell. Meanwhile, we have these supply chain problems, which have been much more severe than we expected. We did not expect them to last this long and create another set of hoarding of goods, because people are afraid they're not going to be able to get holiday gifts if they wait too long. So we've had yet another scramble, and this sense that the shelves are bare because the inventory's in the homes. Again, did not expect that. So we believe that businesses might be thinking falsely that they need to keep scrambling to catch up with consumer demand because they can't keep up with it, and the shelves are bare and they're losing sales. Well, what if the inventory pileup in the household takes consumption down during the all-important holiday month, especially late November and the first 3-4 weeks in December? Then they do have excess inventories if they've scrambled and the consumer does not come. So I think that's going to happen, and I think it will back up into commodity prices as well. And then that would be the cyclical sources of deflation. And I've mentioned many times on this video, the secular forces associated with deflation are powerful, and they are building and they're feeding each other. Artificial intelligence is going to be part of the genomic revolution, and it's already evolving toward autonomous vehicles. So we're going to see one S-curve feed another after another, and all of these forces are deflationary. I've mentioned before, artificial intelligence training costs dropping 50 to 70% per year. I think we're settling on the 60% range as we do more and more research. But think about that. That's 60% decline in cost per year. And it's going to be, artificial intelligence is going to permeate every sector and every industry. So what are the markets telling us about inflation? The markets are, they're actually conflicting. They're sending conflicting messages. Let's start with the stock market. The stock market itself is up. So it's not worried per se, but if you look at the sectors performing, you've got energy and financials at the top for the year, 54% and 35% respectively. Those two sectors are associated with strong economies, very strong boom time economies with a yield curve steepening, meaning long rates are rising faster than short rates are. Well, so that would be consistent with inflation. But the other two top performing sectors are real estate and consumer discretionary. And those two do not benefit from inflation. They benefit from inflation coming down and lower interest rates. So that's very interesting. The stock market is confused about this topic. And what about the bond market? The bond market is clearly in the lower inflation, if not deflation camp. Now, there's some confusion even there because the tips suggest we're going to have negative real growth for as far as the eye can see. Obviously, we don't think that. I don't know why the bond market is saying that, and it's been saying that for a while. But in terms of the actual interest rate level, I think we're below 1.5 today. It has not continued to go up in support of this inflation narrative, not at all. So the bond market is squarely in the lower inflation, if not deflation camp. The dollar's going up. That is an anti-inflationary force. Crypto is in the inflation camp. If you think about Bitcoin as being a hedge against inflation, if that's how you're thinking about it, or NFTs being a hedge, collectible, a hedge against inflation. So that could be in the inflation camp, as could housing. But let's talk about both of those. These are real assets, yes, and they can be hedges against inflation. But the stock market and the bond market are also assets. And we've got all markets rallying. All markets are rallying. And could this mean, therefore, that velocity is going down, the velocity of money? What does that mean? Now, this is a little esoteric, so forgive me, but I think it's really important. If consumers are spending their money on assets instead of goods and services, then what's happening is all of the money printing that people think is going to cause permanent inflation in the price of goods and services, that is wrong, that it's actually moving into assets. So velocity involves GDP and money growth. GDP is the production of goods and services, not assets. So the velocity of money has been coming down because people have been saving and putting more money into assets. Is that what's going on here? Well, in the GDP report this week, I think it was, or maybe it was last week, real GDP growth was 2%, a huge disappointment. But what the headlines did not capture is if you looked into the guts of the GDP report, what you would have found was the only reason GDP grew was inventories. And everybody thinks we're terribly short of inventories. Real final sales, so this is taking out inflation, real final sales were slightly negative. Now, could it be, and I'm seeing this behavior on the part of millennials, could it be that they would prefer not to spend on goods and services, but to invest, especially in crypto and NFTs and stocks? So very interesting there. But in terms of housing as an inflation indicator, Ivy Zellman of Zellman Research came out this week. She made a fantastic call on the housing bubble and bust starting in 05, 06. And she was right, just a little early. She is very concerned that the housing prices we're seeing now are not sustainable, and for a few reasons. There is a lot of speculation, and two of the reasons include iBuying and private equity. So iBuying, so that's when online brokers, real estate brokers, are willing to buy a home from someone who wants to sell, renovate it, and flip it quickly, and take friction out of the home selling and buying process. Well, one of the major iBuyers out there this week basically pulled out of that market and said, "This is unstable. This is an unstable situation. We're losing money. We're not going to bet the company on it." And I thought, wow, okay, that suggests something's changing in the housing market. We're also seeing massive inflows on the part of private equity because, and we have since 08, 09. They've made huge amounts of money from real estate, and they're continuing to pump more, buying up large tracts of homes all over the country, and then selling them off at a profit after renovating. That is unsustainable. And we're also seeing a lot of pre-market buying. This home, a real estate agent says, well, this home is not on the market, but I think I can get the owner to sell it at this price. We're seeing a lot of that here in St. Petersburg, Florida, and I think that's happening around the country. So not sustainable. And so I'm wondering if even the housing market inflation is going to give way here. And then the final thing I'll talk about, just a few things in terms of the stock market itself and high valuations. The Peloton news this week, today or yesterday, about a big miss is feeding this stay at home is done, get out of those stocks, they're too highly valued. We think that Peloton is an exception to the others like Zoom and Teladoc, for example. Peloton was really a stay-at-home company, a purchase. I wouldn't take what's going on in the market, especially very recently, to suggest that the stay-at-home stocks are done. We don't think so. We think they've changed the way we work, the way we live, education, medicine, and so forth. So just wanted to get that one in there because it's quite topical. And the final thing I'll talk about is Bitcoin. Just some very interesting news. 3 regulators got together and wrote a paper which basically saying this is how we'd like to regulate stable coins. And the market took it very positively. No surprises. This had all been articulated and expected in some way. As far as Bitcoin specifically, we thought there were a couple of very good moments this week. Eric Adams, who just was elected mayor of New York City, said he would accept pay in Bitcoin, and the Miami mayor said he would accept much more than, I can't remember the time frame, in his salary in Bitcoin. So we have some friendly competition. They both want Bitcoin in their states, so Bitcoin developers and the Bitcoin ecosystem, which is fantastic. And then Square, Jack Dorsey, when asked on the Square earnings call today, would you consider supporting any other cryptocurrency? And he said, no, just Bitcoin. Bitcoin is the native currency of the internet. And so we thought that was very interesting. So with that, I will close for now, and thank you very much. And let's hope that the markets continue rallying, all sectors, all asset classes through the end of the year. And I wish you all in advance a very happy Thanksgiving. We do have a lot to be thankful for. So thank you.